All right, welcome to my Lightyear portfolio update. This is a portfolio that I started just a few months back on the Lightyear platform with the whole idea that I would buy some of these US tech stocks that have been absolutely hammered down over the past few months as we started 2022. So without messing around, let's go straight into the portfolio. So I'll bring up a screen recording now of my portfolio. So I've made kind of several different purchases. I've kind of nibbled away. I still didn't get the bottom. I'm still no amazing stock guru. So you're always going to wish you would bought a bit later and waited until just a couple of months ago when the market has hit the absolute bottom. But overall, I'm very happy with where I've made my purchase. Anyway, we've got loads to cover because, of course, as you might know, it's been Q2 earnings season. So all of the companies have just reported. So we've got loads to go through. We won't go into too much depth or too much technicals. Otherwise, we'd be here for hours. I'll just kind of pick and choose some of the highlights and some of the lowlights and kind of where my head's at with these different investments. Anyway, let's have a look now. So working our way from the bottom, actually my smallest position and the biggest loser so far, even though when I was purchasing this, clearly it had already been beaten down, but Block has been on quite a journey. If we look through the share price of Block over the past couple of years, it had a huge run up. Now, of course, there's no surprise why it had such a huge run up. Of course, lots of hype around the business, that it is got a few different revenue streams. As you may know, Block used to be called Square, is a digital payment service for small and medium-sized businesses, and they also own the Cash App, which is something quite large in the States, not so big in Europe or the UK, that allows people to pay each other, take out loans, etc. They also own Tidal, which is a music streaming service, and they also acquired a company called Afterpay. So they're in that whole kind of buy now, pay later, payments processing, kind of lots of stuff going on in this business, and lots of excitement, of course, because the founder was Jack Dorsey, who founded Twitter, no longer on Twitter's board. Of course, lots going on with that company as well. Now, the company, of course, has been beaten down significantly since when I bought it. It's 27% down just since I've owned the company, but it's massively down from its all-time highs. No surprise there, of course, as those big macroeconomic headwinds have come about: high inflation, low growth, concerns about stagflation, concerns about small business, of course. And if that's where they're getting their money, taking a small cut of payments most of the time, then it was no surprise that investors have kind of fled away from companies like this who aren't particularly growing profits massively at the moment and are still in that growth phase. But anyway, even though the company has been generating fairly good free cash flows, of course, it is operating at a loss if they plow basically all their money back into the business to help them grow. The last quarter earnings literally just came out yesterday. They did miss on a couple of key metrics. They did actually increase their revenue, but of course the street wanted them to make a little bit more profit, and they unfortunately failed on that part. And of course, they did take a big hit on their revenue on their Cash App with Bitcoin transactions as well, because of course, as crypto's fallen, then the value of their percentages that they charge between people buying and selling, of course, is going to take a bit of a hit too. And as you might expect now, I'll pop these up on screen from their Q2 results. You can see that the costs are rising fast. This is a very common theme between most of these companies in that tech space. Of course, all these engineers and the talent amongst the tech sector all want to be paid a lot more money. And of course, their costs are rising heavily with inflation all around the world as they increase headcount, increase and grow their business. And of course, they do have some hardware in there which they have to support as well. Now, and a positive reason why I quite like the business, of course, as they grow and help their customers and help their small and medium customers actually grow their business, then they will also actually grow because they're going to take a percentage cut, and it's a subscription service that it's not just the front of house taking the payment. And I'm sure you've probably seen these payment card readers in, I don't know, a coffee shop or something like that. Of course, cool looking devices, but it's actually the software and the ecosystem behind it that I think is where the moat is and where the money is. There's certainly competition in the space, so the moat isn't necessarily the fact that they can take digital payments. That is certainly not unique at all, but it's the whole ecosystem that allows the business to operate and run. Everything from being able to do the rotors, being able to do their payroll, and of course, you know, personal time off, those sort of things. Having that all in one package means that you've got a subscription service that's fairly sticky and something that a business probably doesn't want to turn off. So I'll be very interested in to see where this company goes. I think there's plenty of short-term pain to come, in fact, for most of these businesses, but I'm very excited to see how this business can go long-term. And I'm only allocating quite a small amount of capital to see where it can go. Also, if I just jump into my own little kind of discounted earnings tool, which I might actually break down a separate video on, if you are interested, do let me know. And I do think the business is quite fairly valued at the moment. And if I've inputted some, I don't know, fairly conservative, fairly reasonable kind of rates of growth and a discount rate and a low net income figure, I do think the company has a long way to go. Now, of all the companies, it's the smallest company. So in theory, I'm hoping for it to grow, of course, a lot quicker than a lot of these other companies. But I think with some fair assumptions, I think the company has a long way to go. So be really interesting how this one progresses. Okay, next one up, YouTube's favorite stock, and every hypester's favorite stock, Tesla. It just seems to always just keep going up and seem to defy gravity. In the news recently, of course, they've just approved a 3-to-1 stock split. So Tesla did have a big shareholder event yesterday, and they did confirm their 3-to-1 stock split, which they're going ahead for. So remember that a stock split doesn't do anything for the business. It just literally splits the stock. No business valuation or anything like that actually increases. Although, of course, it's great for marketing. People get very, very excited. It's probably priced in at the moment, but I would still not put it past the company or put it past shareholders that will probably see a further increase in this stock purely because of the fact that it looks cheaper and people want to acquire more stock. But hey, if we go through recent Q2 results, again, surprisingly, the company did very well considering all the headwinds. There were lots of lockdowns in China with the different plants closing down because of COVID restrictions. So that restricted a lot of the output of the company. And of course, just like the rest, as we said, inflation has pushed costs up just that little bit higher. So those margins are squeezed. But of course, being Tesla, there's still a huge amount of demand out there for their products, which don't seem to be slowing. People are being pushed back down the queue, unfortunately, which can have a huge effect, and people potentially are moving to other manufacturers. But I think it'd be hard to say otherwise that Tesla isn't leading the way in that sector. A couple of key things you'll note in the latest results, they did sell 75% of their Bitcoin, which did help their cash position a lot, which kind of made them look a little bit better than they would have been otherwise, which means they've only got a very small amount of Bitcoin left. So much for going Bitcoin to the moon. They've pretty much sold it at its worst point, and they've missed out on quite a lot of gain. So that's quite an interesting one. And just finally on Tesla, before we do head over to the next stock, just one thing I wanted to highlight for you and how important buying at a good price is and making reasonable expectations on a company. So let's assume you're a massive Tesla bull and you say that the growth rate per year is going to be 50% every single year for the next 10 years. What that does to your revenue at the moment, the trailing 12-month revenue for Tesla is $62 billion. In 10 years, if you are able to grow that by 50% every single year, forget about profits for now. In year 10, your revenue is $3.5 trillion. Now, does that seem reasonable to you? It could absolutely happen. But just to put that into perspective for you, Walmart right now, the largest company in the world by revenue, does $570 billion, and Apple does 386. So in 10 years' time, can Tesla generate that level of revenue? It's certainly always possible, and I wouldn't put it past the company, but just be reasonable with your expectations when you are trying to work out, is this a fair price for the company? Because how much of this is really baked in is always going to be a huge question for investors. But generally, this is kind of a good thing to get in your head if you are going to be buying individual stocks anyway. Remember, I'm no expert on this side by any means, but I do definitely like to consider what I'm paying for a stock. Next up, Meta. Now, it's probably going to be one of the most controversial stocks, if you like. It's obviously a crazy cash machine producing business, formerly known as Facebook. Of course, I'm probably going to interchange the word Facebook and Meta here as we talk. Now, of course, they've got multiple different platforms. You've got the Facebook platform itself. You've got the likes of Instagram as well. Of course, you've got WhatsApp. I'm sure every single one watching probably uses WhatsApp and has multiple groups going at one time. So they have this huge ecosystem, huge amounts of information on their customers. And of course, the money they make comes from all of that digital advertising. But now the big kind of controversy, I guess, is how much bet and how much money you want to spend and invest on this whole metaverse and ecosystem in the new kind of virtual reality and augmented reality world that we're moving into. So look, on the pros side, of course, the company makes a lot of money. They're highly profitable. Their position with their cash, with their balance sheet is absolutely phenomenal. There's no denying that. The big issue now is how much per month and how much per year keeps going into this metaverse, and whether we're actually going to see any profits and whether we're going to see some growth in that space in the future. End of the day, we could be dozens of years away from huge potential growth in that space. It could end up being a massive no-brainer, and everyone 20 years from now says, why didn't you invest in Meta? But who knows? Now, my personal opinion is I definitely see the use cases in this space. I think they're kind of unlimited, other than just saying, I've got my Oculus Quest here for my own entertainment playing games, but I can see plenty of use cases, whether that's doing working, you could be doing remote engineering, you could be doing remote teaching. There could be some phenomenal use cases. How you monetize that though, and how profitable that will be, and how much you've got to spend to get there is really the issue. In their latest results, which they just released, all these thoughts kind of just reflected. Their monthly active users and daily active users were up slightly, which is very impressive because it's very, very difficult when you get to a company this big to actually get even more users on the platform. So that was really impressive. And from my valuation perspective on my kind of little discounted earnings sheet, I've said if they can kind of grow about 12% a year, and even make a little bit less profit than they are now, I still think it's a very, very good buy. But Other people would say it's a value trap and get themselves way out there, because if a company's looking very, very cheap on the stock market, then you have to ask yourself, why is it so cheap? So either Wall Street doesn't get it or you don't believe in the metaverse. But anyway, I think there's definitely still legs there. And let's say, even if it fails, I think the company's in a very good position to kind of turn things around. And I think there's plenty of growth out there. Just quickly before we do head on to PayPal, if you do want to follow my links in the description below, you can get yourself some free cash for signing up for Lightyear. I'm not sponsored by them or anything like that. It was £20 last month. For the 10 people that did sign up last month, they got £20. Congratulations, well done. Unfortunately, they've stopped that now. So it is just £5 for signing up once you deposit 50 quid. And I will also get £5. But so yeah, unfortunately, it is just £5 at the moment. If you do see a link in the description and it says £20, unfortunately, that's outdated now. But feel free if you want to give it a go. Remember, there's no stocks and shares ISAs at the moment. This is just your regular trading account. So please be aware of that and just be really, really careful, of course. It is individual stock picking at the end of the day, and it is very, very difficult to beat the market in the long term. But hey, if you've got a bit of money on the side, I do personally find it enjoyable. Okay, on to PayPal. Now, this stock, again, has had another incredible ride. I mean, the last couple of years with hype stocks and growth stocks has just been incredible. You go and look at how high PayPal rode up, and people still thought it could just go higher and higher. Now, the crazy thing about the pricing of PayPal at the moment is it's actually around the same price as it was back in April 2020. And we all know what happened there. So it's almost like the market is saying this business isn't any better than it was back then, which is just incredible. However, at the end of the day, the market ultimately is forward looking. So the market is potentially saying to us, PayPal, yes, it used to be a fast grower. Now, is it going to be a grower as much? It's a very big company at the moment. So investors are kind of saying, okay, we don't think it's going to grow as fast and exciting as it is, and it's not going to make as much money. And that's kind of what's priced in at the moment. However, diving in some of the financials, you can see the company is a very, very well run and efficient business. They do make a ton of profit. They're very, very profitable, and they're in a very good position in terms of their balance sheet. And they are actually growing their business. Although their latest kind of forecasts and predictions were for a bit of slowdown, they did, as you'll see on screen now, actually manage to beat their most recent expectations. And the share price has already made a massive 30% move in the last month. So arguably, I think the market was expecting things to be a lot worse, and clearly it's not as bad as we all thought. And a couple of things here which kind of propelled them forward is Elliott Management have taken a stake in the business. These guys are known to help turn things around a bit, because I think they want to trim a bit off the fat, make the business more profitable, and keep it growing at a really attractive rate. Now, I don't know about you, but of course, from a moat perspective, PayPal's brand and PayPal's name is phenomenal. If you're ever doing any online shopping, personally, I'm going to choose the PayPal option, especially if it's a site I haven't used before. And that really is a massive moat for the business, and that trust they've built up. You're going to choose PayPal over another one, and I think that really is the reason why people want to trust them. And then from a merchant perspective as well, again, it's that trusted brand, it's that trusted name. So even though potentially there is a lot of competition in that space, building up that brand and building up that trust for me does give this business an effective moat, which I think is extremely strong. And certainly from my perspective, I do have the philosophy that if the company does have a really effective moat, then I'm happy to pay a good, fair valuation for it. Not expecting an absolute bargain, but I think fairly priced at the moment. And now finally, Google. I don't think this one needs a huge amount of explaining. We all know and love the platform. Of course, you're watching me on YouTube, currently owned by Google, or Alphabet, we should say, as the parent company. Of course, largest search engine in the world being Google, the second largest search engine in the world being YouTube. And then of course, they have their Google Cloud, and they have other bets as well that they do use some of their capital to invest into other businesses. Now, a couple of recent things that have happened to the stock. You've had a big 20-to-1 stock split, because Alphabet stock, the Google parent company, used to have a huge share price well into the 2000s and actually hit, I think, over $3,000 at a time. So now we're in a much smaller range, so people can trade it freely. And I think what's interesting with Google or Alphabet is there's just so much room to grow this business, even though it's already a massive giant. And again, if I go back to my kind of basic valuation tool that I was playing around with, even with some very, very modest and very reasonable growth, I still think this business is massively undervalued as it is at the moment. I could absolutely be wrong, but I think in the long term, it's a fantastic business. And let's just go back to that moat. I think that's incredibly difficult to challenge at the moment. Unless Bing all of a sudden is going to be the #1 search platform, it's incredibly challenging. Now, of course, not everything's going to be completely rosy. Let's not forget that ultimately it's an advertising business that are going to rely on businesses to spend. So if we do have some massive headwinds, those small and medium businesses aren't going to be spending all of their money on Google advertising. So there could absolutely be a slowdown in that perspective. But in my personal opinion, that's a kind of a short-term thinking. I think in the long term, if you are a business that wants to grow, you are going to almost have to use Google as a platform, and potentially also have to use Google advertising on YouTube as well. And we haven't even spoken about their cloud business as well. Now, they do need to compete a bit more with AWS and Azure. And I know that their cloud business wasn't necessarily growing as fast as those guys, and it is an unprofitable part of their business at the moment. So it is sucking a lot of that cash out. But the moment they can turn that one profitable, as we already know, cloud services for business is extremely profitable, because once you scale, you've got all of that kit, all of that data center kit, which you can use and spread out amongst your customer base, so you can kind of reduce the fixed costs across all of those customers. And hey, eventually, once it gets so big, maybe in 10 or 20 years, can you imagine Google being like a dividend payer, paying like 5 or 6% or something crazy like that? But who knows? Anyway, there you go. There's the whole portfolio. Sorry, it's probably been really, really long. There's been loads to get through, so many earnings. I've done a terrible job of going through all of that stuff. You could spend an entire video going through each of the individual earnings, and I've probably done a very, very terrible job of explaining that one to you. Make sure you look after yourself. Remember, I'm not a financial advisor. These are just my holdings at the moment. I'll share with you, try and get this one out now every month, and feel free to use the link in the description. Don't forget, the first few people will get just £5, but hey, it's free money at the end of the day. Anyway, thanks so much for watching, and as always, happy investing.